Hello from the children of planet Earth. Hello from the children of planet Hello from the children of planet
What's up, friends? Good morning. All right, S&P already trading an upper DD band, giving back half of its gains from yesterday. Gold, Bank of Japan, Catalyst, yada yada. Market can't wait to continue longing. I'm sure every dip's gonna get bought up. Still, VIX is somewhat decaying, but not in the clear yet. Obviously, hitting upper DD band is a caution already to start the day off, but we'll see what we get. Y'all smash that like button. Get ready to go. Did I see what options chat? I did not. I'm not particularly reading chat in Discord most of the time. You have to message me. What'd you say, Alex? Tag me or message me? I don't see it. 12:30. Okay, let me look. Hold on. Yesterday? I don't see anything in options chat yesterday. From you. All right, DD broke outside DD band, irrational upside today. You always know after the day after Fed, typically you do get a sell-off and a dip. So clearly, this is already ending the upward momentum of a trading day. We don't bet that we go beyond it. We'll see what happens in here. Obviously, you can see that the market is still squeezing back to revert to the mean of this. Let's do a quick impact line, see if we get anything. Make sure we have all our things marked. All right, make this bigger. You just tag me? Okay. I know what chat room it is, but what are you talking about? What error? Don't just tag me and want me to go. Hold on. Don't just tag me and make me go thumb through chat to find something you messaged. You can reply to the chat so I can see it. I know where the options chat room is, what I'm saying. I still don't see your message. Like go reply to your own message and then tag me in that reply, and then I'll see, then I can just click it and join the message. All right. Can you go ahead and not, yeah, there you go. I see you doing it. It's already been done. Just doing a quick impact line just to see if we have anything event-wise, catalyst-wise from the other day. That's definitely one that that one there as well. There's that run length been tapped. Okay. Let's go ahead and do a 31-point move. So let's go off of, all right, 26B 95 on the dot. This is where your catalyst was from the other day. So this is obviously the return pivot. I'll just draw this kind of sign. Yo, Alexander, this exercise is taking like 10 minutes. Can you just tag me real quick so I can read it? This is So what you saw yesterday, daily on Roxy had a bottom of bull zone. It said say 429, but when you go to market maker, bottom of bull zone. Where did it say bottom of bull zone? I don't get it. Yesterday, daily on Roxy. Look, you're gonna need to help me out real quick. I don't have time for this. That I can't understand what you're trying to convey to me. Post like a side by side of what it is you're actually trying to talk to me about. No, it's okay. No, it's just what you're saying. It is I don't follow any of it. Yesterday, daily on RS had bottom of bull zones. You're not telling me what ticker. You're not telling me whatever. I gotta tell you guys, I love y'all to death. But when y'all talk to me, I'm a guy on a stream, right? Just pretend for a moment I can't read your mind. Just pretend. Let's assume that's the case. You got to tell me what the hell you're talking about. What ticker are you looking at? What chart? Go deep. Go deep, my friend. You got to let me know. Put side-by-side pictures. I'll look at it. Just got some time for market opens 15 minutes, and we'll go through it. SPY. Give me all the details. Yesterday, daily on SPY had a bottom of bull zone at say 429, but when you go to MM bottom of bull zone, I don't know what MM bottom of bull zone is. When you go to MM bottom of bull zone, what does that even mean? When you go to monthly map, bottom of bull zone was 456. Oh, okay. That is what you're saying. I got you. Okay. I don't see a picture, so let me go see if I can see what it is. Okay. Monthly map, bottom of bull zone. Oh, okay. Okay. That's what you messaged me about yesterday. Okay. I remember looking at it and looked. That's right. You did message me about that. Okay. It could be a display issue on monthly map. Yeah, good question. Let's go. We'll check it today. Okay. Thanks for help. Thanks for looking at this. All right, you guys can ready to get started. We'll look at it when it opens. So, love you, my man. Appreciate it. Easiest way to do it. Well, here's the thing. Monthly maps is not looking at. It's splitting up all the dates. Liquidity map is going to compile them all together. They're going to be different. Like, this is not today's liquidity map, if that's what you're saying. Like, for instance, what you see right here for SPY, this isn't the bottom of the bull zone in liquidity map. This is just today's expiration. Liquidity map contains all expirations. That's probably why you're seeing a difference. Like, for instance, this bull zone right here, it won't be... Yeah, 429, right? This is yesterday. Oh, my bad, my bad. Okay. Thanks, I'm sorry. Okay. Ready? This is what it is. All right. All right, so this right here is liquidity map. Right? Hold on a second. Um, oh, God dang it. Okay. All right. No wonder nobody was saying anything. Okay, let me start over. Alexander, this should answer your question. I keep my mic was muted. Okay, ready? Liquidity map is built on all options at all expirations minus the monthly. The bottom of the bull zone, 429 is what you said. Why is it different than the bottom of the bull zone here? Because this bull zone is just the 27th of July. This is just one day. Monthly map stretches them out and applies draws each expiration's map of just that day. The liquidity map on this day on the other chart encompasses all of the options in a different algorithm, which is why this doesn't go down to 429 like the liquidity map does. Cool. Hopefully that makes sense. So a liquidity map is all options squished together like sandwich, like a slinky. Okay, that's why they're different. There's no display issue at all. We good? Cool. All right, let's go get started. The first bar monthly map is for today. Correct? Yes, this is just today's expiration. So like if you were to do like the monthly map right here of the first day when it refreshes, it'd be the same thing as if you go here and you click single date and then you actually tell it today, it would actually match the monthly map. So monthly map is like a daisy chain of a bunch of single dates. That should hopefully answer your question. Okay, let's get ready to get started. Right out the door, let's talk about some news that we had. Love you guys. Welcome. Smash the like button on the stream, please. Got a bunch of, you know, post-Fed sell-off is a pretty normal thing. This yesterday's kind of sell-off was not abnormal. So, you know, I'm not even sad at all about what we've experienced, what we've seen. Doesn't jolt much. Today's so let's refresh this. Today's data coming in through. This is core PCE, slight miss, employment. Let's find some personal spending slightly up, personal income slightly down. These are all relatively flat. Some beats, some misses, but nothing alarming. Yesterday's news was alarmingly bullish. Everything that came through yesterday was just crazy good. Continuing jobless claims, a huge beat. These are people that have been unemployed. They can't get their jobs back. Now getting their jobs back. Tons of them. Core durable goods orders, that's going up. Core PCE prices coming down. Durable goods orders month over month. So this is a core. This is durable. This is a huge, huge, huge boost. I mean, this is crazy big. GDP quarter over quarter, 2.4%. I mean, listen, I just don't get it with these bears. You don't have you just don't sustain positive GDP growth in a recession. Here was your recession, you know, the tiny period that you had lack of growth, and here's the COVID shutdown. I mean, to me, this, you know, here's 2009. You want your recession? I mean, this is recession. I mean, this is the easiest thing in the world to see. See when GDP growth is negative. There's your classical debt. Get your economic textbook. You remember that 2008 recession we had? Remember that thing? Remember GDP growth in absolute decline, quarter to quarter, like literally that. There's your recession. You guys see that here? You see COVID? That's your recession. You're literally just forced one for a couple months. And then it took like maybe half a year to recover. And then, you know, we had a little bit of one at the top of the stock market when the QT was announced, rate hikes were announced, market pullback. We've exited it and we're continuing to grow. You don't have in a recession, there's no looming event. There's no, oh my God, the rug's about to get pulled. Unless there is a catalyst that shifts the market down, all signs are healthy in the economy, at least for now. And change my tune here. Start to see anything differ. But the initial jobless claims or initial layoffs, those are going down. Fewer people are even getting laid off on top of people getting their jobs back. The jobless claims total 4-week average, just watch this guy here. People going back to work and GDP going up. There's no better recipe on the surface for what is considered economic growth and exiting a potential recession potential. Now people are talking about credit event this, trading over earnings that. Let me tell you, best thing I ever could teach anyone. Ready for this? You guys ready for a bombshell? Is that never underestimate bullish stupidity. It's okay to be stupid and be a bull. There's nothing wrong with that. That's how you make money. You don't make money because things are trading at earnings. Or trading 5 times over earnings. Or you make money being a bull before other people are bull, and then stopping being a bull once they stop being a bull. This is how you make money as a trader. Don't ever underestimate bull stupidity. Don't ask why too much. Well, why? It shouldn't be doing this. Shouldn't be going up. Shouldn't be trading already. Don't. The exhaustion of the rally, it stops when people are done being stupid and buying. You need an example of that. If you haven't been trading 14 years like I have, you need an example of that on the tip of your tongue. Remember those monkey pictures everybody used to buy for hundreds of thousands of dollars? You remember when they were trading 10,000, they moved to 20 and 30 and you thought that was stupid? And then they went to $250,000 and then that was it just was stupid to you the whole way up and you shorted it from 20,000 probably, and you just literally, it stops going up and people stop wanting to buy. That's it. There's your answer. Don't guess. You can't guess what Wall Street wants to do. Don't try. Don't even try. Don't waste your money, your life, your time, your sanity trying to guess. Just like a surfer, grab your surfboard, ride the wave. The signs will be obvious when they're done. We literally watch the market for you and yell and scream and talk about everything related to positional data. And we will know when they're done because the signs will be obvious and the writing will be on the wall when they're done. You guys got that? We all good? Somebody said they can't hear me. Can y'all hear me? Hopefully y'all can hear me. We can start in 1 minute. Are we good? Hello? Anybody there? Is my stream frozen? Okay, I'm going to end the stream then. I'm going to count to 10, end the stream. Can you guys hear me? Something must be wrong. Nobody can hear me. Okay. This is very odd. Nobody can hear me. What the hell? Oh, weird. Okay, so YouTube was frozen for a second. Okay. All right, cool. We back now. Let's. Wow, look, all the chat just came through. That is so weird. Okay, it must have been a YouTube thing. All right, we live. Let's go. All right, SPY out the door. Resilience positive. Nasdaq resilience positive. Looking good. We're at upper DD band on SPY, so be very, very careful today. Okay, we're looking good here. Opening here. Open. It's a BLU. It's UQQQ. Okay. I don't know what's going on with the internet. I think somebody's on their phone or something here. I don't know. There's a bunch of people in this house probably using the Wi-Fi or something. That's probably what fucked the stream up. I probably just need to reboot the router or something. I've never had such a low bit rate on the stream before. Maybe YouTube just having problems. Okay, cool. Let's go. Yeah, futures looking sexy. We got the DOM up, got the futures up. So basically, last couple of days, we've been trying to get everything worked out. So I'm going to see if everything goes well. Let's see how the data is looking. Just kind of eyeballing this. Everything's looking. Where's my candles? This is okay. Let me refresh. Let's take a look really quick. SPY's at upper DD band, so this is already a trade small day. Nasdaq's pressing through its DD band, but it's looking good. Like I do like what I see. So. All right. Let me get my DOM back up. This is MES U23. I think the U is just the 3 is just not showing right here. All right, so it's just double checking everything. All right, good. Looking good. Bull long up. 455. Nice. Nice. Where is my data? Let's just see really quick. All right. MES, let's test this out. Oh, all right. Let me try this again. This is my brokerage disconnected. Let's do it one more time. Okay, hold up. Let me connect. Let me reconnect. Oh, hold on. I have to actually refresh. There's something going on with my login. One second, you guys. Growing pains. All right, check it out. Hold up. All right. One second. I'm gonna reload something on my platform. I'm trying to get everything to pop back up here. All right. Not really sure. Give me a second, you guys. All right, give me one. Give me 1 second. Well, actually, just go back to here. We're gonna look at it in a minute. Somehow my connection tab disappeared, so that's really weird. And they're gonna look into that. But anyways, let's take a look at the market. I'll have to get him to fix something really quick. All right. All right. Yeah, futures are looking sexy. I know. I got a trade off yesterday, but the funny thing was it didn't display on the actual chart in the DOM, but the trade went through, so I have never had a confirmation. I spammed the button a couple of times just to see if it was like not working or whatever, and went through. I got in 3 micros, and then last couple hours a day, market was falling. I was on the phone with the broker talking to him. He's like, "You know, you're in a position, right?" I was like, "Oh, well, I can't see that." That was $500. It was hilarious. So, all right. Okay. Trade events doing the same thing. This was our implementation. For some reason, this is the same part of the same bug. My connections tab is gone, so my brokerage connection is severed, even though I'm connected in my other browser. So it's really odd. Refresh here. He's gonna look into it. One thing, let me see if that actually brings the DOM up. It's connected even though the connection is gone. Okay, cool. So let's pop out a spy chart. All right, this is fun. I'm playing with this for the first time live with a actual, oops. So this is fun. You guys can experience this with me. All right, let's do a bull long up. Let's just see if I can't get a, let's do one micro. Okay. All right, actually, I know you can do like trade settings. Let's go ahead and do instant orders placement. Let's see if I can buy something and it shows up. Order one placed. Ooh, okay. All side by quantity one. Working. Not filled. Okay. Let's see. Every day we get one more piece going on the live account. So now, yesterday the order went to go through. Now the order is going through, which is good. So nothing has been filled yet, but that's good. As soon as we confirm each piece of this, like I said, this is a very complicated project. Last couple pieces is to display everything, making sure everything's connected. Oh, let's reconnect. That might be part of it. Let's try this one more time. And then we're filled here. Lovely. All right. Every time I'm going to refresh this just so it refreshes. Market's nice and bullish today, you guys. I'm loving it. Okay, one more thing. Summary, log, orders. Okay, perfect. Perfect, connected. Just a few more. All right. All right, let's try this really quick. Yep, things are looking pretty stable. Belong up outside DD bands on NASDAQ. Everything's just looking good. I mean, nothing is going to pull back. This is a good. All right, let me try this one more time. And then I won't fiddle with it anymore. Let's get that up. right. I should eat some olives. What do olives do? Is this for good luck? Yeah. All right. We'll fiddle with this later. Okay, let's go back. That Dom was pretty sexy though looking. So what? I don't think it's actually making its way through just yet. So I'm gonna test it. Let's test out stream. Okay, bull long up. Looking here. This is the DD band on the S&P as well. So just be careful. Really, in all honesty, this is just one of those days that the market's either going to be irrational on the upside, where there's no gauge to how far it goes. Irrational. If it trades within. We already tapped it, so it's that yellow light, right? That yellow light caution. So anything up here is a small trade anyways, if there's something I did want to do. Bull long up, clearly holding hedge pressure is what I want to see. As long as resilience stays positive, which is good, we will likely hold outside of that box. Now remember, resilience is starting to decay. Market is trying to find some selling pressure. Alrighty, so I think I like what I see. Let's double check QQQ. That's the one that's moving today. QQQ rallying up. Now remember, DD bands on Qs are actually much lower than this. I'd say that they are probably about here, give or take. Let's look at RTY, because RTY was basically shitting the bed yesterday. Basically, like one were to take any trade today, longing with a very small position with a good risk and good reward from hedge pressure is probably what I'm looking to do. 46.20 is a red line, so 46.20 up here would be about a 20-point run if it continues to go, with about a 5-point stop. So the risk and reward is there. It's pretty decent for a nice little bump up trade. All right, I like what I see. If you don't mind smashing that like button, friends, let's go. I'm always multitasking. I need to. Great question. So the answer is we're discussing here that what happens longing to open long, open on a BLU is pretty common. So that's a normal scalp, and that's not really a lot of points to get. And usually when you tap the upper DD band, that is the end of the day. However, one thing to take note of is that when you do touch the band one time, that's already no longer considered. So you can see in the pre-market, I think we did tap it, or we got one tick away. So in reality, the day ended right when the market opened, right here anyways. So any additional trading is to bet that it continues to break and go forward, which is not something we normally do. Like if you have a nice run to DD, I usually call it a day. But if you're right on the edge with hedge pressure like this and the market is irrational after a big sell-off and we're going to return back to normal, like if you're super bullish the market, then trading very small to bet on a big run is something that a lot of times I'll do. So right now, the bet that, yes, normally you would close out, I'm talking to one of my students here. Normally you would close out when you hit DD band and just call it a day. But in reality, to get, 5 points is really not worth anyone's time. For a bigger trade is that the illiquidity part of the market, which I'll talk about here. When you study illiquidity pivots, we call them red lines. This is the return point from yesterday's sell-off. You see right here, 46.20. So a smaller bet from here to there, because we're outside of DD bands, is a potential trade with a very small position. Normally if I do like 10 minis, right, I might be doing only 2 to run to there with an adequate stop, which is right at hedge pressure. Because if you see that you can always do risk and reward on any trade. If you haven't covered red lines or illiquidity pivots yet in the exit targets, it's one of the more advanced concepts, but I'll usually give you the number every morning. So as you see right here, as long as hedge pressure where my mouse is equivalently where hedge pressure is right here. And so a 10-point stop would be right here. And if you're to measure from here to there, betting on the break, which you normally don't bet on the break, especially if it's in the middle and travels to it, 10 or 20 points, I usually call it a day. But if you're right on the band, a lot of times people here will bet on that illiquidity break with a very small position. And as long as the risk and reward is adequate, so you would measure, like if this was where hedge pressure was, 91 to 20 is a 30-point run with a 10-point stop. It's like 3 to 1. So it's worth taking, but obviously the market's irrational. So anytime you're irrational, you trade small and allow yourself to build a position instead of just jumping all in at the start, because VIX, again, is above triple Bs. You have overshoots and things. So you would build a smaller position that way. So yeah, market's looking super great. Honestly, is like an arbitrary target. So let me draw for 58.4. This is about where that impact line is right here. And impact lines have to do with yesterday's sell-off, right? So the idea is that now, hitting that DD band and breaking out, we don't have DD as an entry target usually. So when you're outside the band, just common risk and reward is what's used. I do love what I see. Ooh-wee. Okay. my connections tab is back. That's good. So what we'll be doing is as soon as I can confirm that everything's working fine on our end, basically everything worked with the test API and the test account. And so now when I switched over to live, last 2 days I was working on the connection issue on the live account, and then now making sure orders go through. You got the data feeds coming through. That's great. The DOM is working. Everything's working. The one little holdup is that the orders are hitting a pending state, not making their way through. So one little piece at a time. I'm going to get that going. As soon as I get all of that going, I'll make an announcement. Everybody who is lifetime will get futures unlocked for you first. Like I said, I'm going to make sure that those of you who are very familiar with everything Rocket Scooter, obviously the lifetimers have a lot of familiarity with the platform. They've been here for a while, and lifetime always gets the beta test the new stuff. You guys get to play with it for like a week or two until we're ready to push it live, as long as there's no issues. Then we release everybody. So if you're in the lifetime group, you'll be the first to get futures launched. You have a lifetime membership. Actually, wait, hold on. Okay. I'm going to try something. I need to send him the console logs really quick. Nice clean day today. Now keep an eye on resilience. This could be an early bird warning, right? Resilience is hanging at 0. It's possible that when resilience, if it goes negative far enough, like less than -10, we could collapse and fall through the box. And so resilience can forecast a hedge pressure break to the downside if resilience just gives up. And it's sitting there right on the edge, which I don't necessarily like, but it's not negative yet. And seeing what the Nasdaq is doing, Nasdaq is practically giving back all the gains from yesterday. I love seeing and I just can't even sometimes with these bears. Honestly, I honestly can't even. I don't know. I think these people troll on purpose to sell newsletters. It's kind of like the news, right? Oh, I guess that dude finally blocked me. So like the S&P was down 30 points. Some I don't know. Again, these people just spew out bear drama all day long. The S&P went down 30 points. It was 0.65%, not even 1% in a single day. And the guy was like, credit event is starting. Beware. Like, people are literally selling fear to traders to convince them on pure stupidity. Literally pure stupidity. Like people that do not know anything about trading or markets. And the guy was like, it's a credit event that's starting. And I'm like, yeah, look, he was like, time to run for safety. It's like, I feel like they do it on purpose so that so essentially what happens is that the news just wants to cater to a side of people for an audience, and that's catering to an audience. I don't understand if that's your narrative, then, and you're the only bear in town, then I guess all the bears will buy your product. I don't get it. I really don't get it. We know the market's bullish. We're going to 500 SPY. We're going to 6,000 S&P next year, and I don't know. But I know I've been making a lot of funny tweets like this, but I think the person finally had enough because I'm retweeting them and quoting them. But S&P was down 30 points yesterday. 30 points. And the mention is that there's a credit event. Credit's going to dry up. The yield curve is inverted, everybody. The yield curve is inverted. Watch out. It means stock market's about to crash. There's a huge credit event. All the people that just got hired back from the companies, psych, we're going to fire you tomorrow. Just kidding. GDP's up. Yeah, we don't care that we're making more product and selling more product. We're just going to slow down on purpose because the yield curve is inverted, and the S&P fell 30 points yesterday. Therefore, I'm really scared of the market. Like, the Nasdaq just gave back all its losses, literally all of them, within the first 30 minutes of market opening. It's like, here's the funny thing. People don't want to be told that they're wrong, and they don't want their viewers to have smart people like me tell their viewers that they're wrong. That's okay. Literally, the market rallied and was only down 30 points, and it was after Fed, and that's very typical. And the idea is whatever happened yesterday is fully priced in today because we returned to where we started. Whatever event sold the market off yesterday, we're back to where we were today, and that's pretty much what you'll expect to see. But you have to understand, hope is a dangerous drug, and the only bear thesis that exists right now is that we were bearish in 2020 and that we were bearish in 2022. If people think that's what makes charts dangerous, you stare at a chart, the chart is their motivation. Well, look at the chart and like, wait, why don't you look at the positional data? I've pushed the short button 2 times this year. Literally 2 times this year. Yeah, your understanding is that the Japanese bank will start regulating. My understanding is that the Japanese market and the United States markets have nothing to do with each other. And if you don't believe me, look at the Nasdaq. Don't even care about Japan. Those knee-jerk reactions, you have to tell yourself. Knee-jerk reaction just stimulated something. After FOMC, they got to burn some premium on calls. I get it. Usually you have a big rally after FOMC. The next day you can sell. Like, people just are taking profit and you're back to normal. So if you really think about what the Fed did, right? We're still trading higher despite rate hikes. Despite all of this, the market is still pushing higher. Nobody, if you have to understand, is that any signs of weirdness across the globe could hint that we have signs of weirdness here. But I mean, in the 82 to 84, in the rate hike, the Fed was raising rates and we continued to rally for many years in the 80s. 5.25% federal funds rate is not a bare thing. The market has rallied through much higher rates. There's no slow in demand, as Miro was saying. There's nothing. Like, economics is a very basic thing. Supply and demand. And I always tell people, never underestimate bullish stupidity. As long as people are bullish, which usually they always are, unless there's little periods where they're not, the job of a trader is not to guess when they're no longer buying. You can't exhaust when somebody's pockets are empty. You don't know how much crypto billionaires that cashed out still are now pumping their money in the equities market. You just really don't know the extent at which humans are willing to spend money. You can watch and use our positional data. It'll tell you when they're done. But if you sit here as the market's rallying and try to guess and try to guess and try to guess, it tells me one of 2 things, Mr. Human Being who blocked me, is that number 1, you're not a trader at all. And even compare yourself to me, we're not the same. People that talk and try to debate with me, who's not a trader, it doesn't even make any sense. We're not the same. Michael Jordan doesn't go to an elementary school and choose a 6-year-old to slam dunk against. This just doesn't even apply. So I like to make sure the truth is out there. You can't like let propagandists sell you bearish newsletters because they make, subscribe to my Twitter for $5 and buy my newsletter. Here's all the bear food for your feast that you want. All the upside down bears gather like a little support circle, jerk and hug each other and cry through their problems instead of just go out there and learn something. I never understood. Never understood. If you need a support group, fucking join a support group. If you need somebody to constantly feed you confirmation bias so that you have friends who are also losing with you and you can cry together, then that's okay. Here, I'm going to tell you, I'm one of the bigger bears out there in 2026. And I'm going to aim to be the first bear to the party, not the last bull to the party. That's the whole goal. And I'm not roasting anyone in particular, but I think it's a little gauche to block somebody who just disagrees with you. I think that's all you need to know, especially someone who's coming across mostly professional. I'm not even saying anything too bad, but somebody really doesn't want any bullishness appearing in their feeds and their comment of their posts. And I understand they're making all their money from selling you propaganda instead of making their money with any kind of trades. And that is what Wall Street's like. So you guys gotta be careful listening to people who just want to talk. Yeah, the day I join the bear party, I'm going to have the evidence that the bulls are done. And then I'll join the bear party and I'll be shouting that the market is coming down when everyone is probably maybe getting close. I mean, we don't know. But I'm going to wake up every day and just see what is. I mean, I'm watching this bull position deteriorate. I'm building a massive, massive, massive swing trade right now. Even now to go higher. Over the next week, I'll be building it even further. People love that confirmation bias. They just want, and again, like, let's just be real. I'm not going to name any news networks, so the algorithms don't shadow ban me, but I'm going to say this is what news networks do. They just polarize you. People want to hear the extreme of whatever their side is, and then there's one for each side, and then you just get spoon-fed what you want to hear. And that's dangerous to an investor. I mean, you need to be very cautious and see what is. And just react to what is. If you're trying to guess, you will always guess wrong. I don't try to guess. You know, it's like, the weird thing is, and I hate to say this, you guys always try to regale me as some kind of like wizard or some shit. And in all honesty, I'm just an engineer and I read the data. I'm not out there with a crystal ball magically guessing right. I'm doing a lot of homework, and you get rewarded for your homework. And I should teach people that. If you do your homework, you get rewarded. I've taught so many people how to read the commitment of traders that it's starting to catch on like wildfires. They're teaching others and they're teaching others. And I'm so happy to see so many people I know, especially in FinTwit, starting to read this and trying to understand positional data. Because people are like, I never knew this report existed. And I'm like, well, yeah, because 10 years of FinTwit is just idiots posting confirmation bias. You don't really get people out there teaching real stuff. Like some of my friends are futures traders of 10 years. They never heard of the Commitment of Traders report. And so it's like, okay, let's get some info out there for people to read positional data. I go enter every bear thread and said, there's not a short squeeze right here. Well, that's just a short squeeze. Well, no, and the shorts are actually more short today than they were at the start of the sell-off. I mean, they maybe a tiny squeeze in the last 3 weeks. But over the course of the rally, look at this. The market is actually at a lower short here than it was here. They actually had a heavier short right here and a little bit heavier of a short here. The market's actually more short from here to there, if you can look at the difference, right? 355, and now we're about 393. The market actually is growing shorter. Not even shorts are not even getting squeezed. Maybe little waves of squeezes, but the real mechanism is asset managers' net long position is getting bigger. It means they're just buying more stuff. And you can't debate that. And even bears are so weird sometimes. They're debating that. I'm like, this is not even an opinion. You can't debate. This is a fact. This is a number. I'm not even interpreting this number. I'm delivering it to you. This number, 270, is much less than this number. This is 760. You subtract the two, that's an accumulation. You added to that position. Well, I don't know if I agree. What do you mean you disagree? What? It's not an opinion, right? That's what it is like. So we try to teach you to see what is, to read what is, and don't try to follow a lot of opinions, and just learn how to read the market. Trust me when I tell you, you will not only see the first signs of a bear market or feel the first signs of a bear market, even if you miss the first week of the sell-off, you won't miss the next 51 weeks of the year. Trying to time that first week is like handing your money to anyone else who's longing. This is what I've learned. I've traded through 3 market crashes in my career. It's okay, if you write down a little fun fact, it's okay to miss the first week of a bear market. It's actually okay to miss the first month of a bear market. And then just join it. Because bear markets sustain for a long period of time. You won't miss out on much. But if you try to be the first one in, when markets generally go up, trying to be the first person to bet on it comes down is trying to win the lottery. It's easier to try to be the first person betting on it going up than going down. But either way, betting on pivots are hard to do. Just join the party. And the signs of the party is over will be very obvious. Very obvious. Better to be late than early, as Gabe said it. You guys, y'all nailed it. By the time the real bear market comes around, most of the current bears will be washed out. And as Peter has said, that's kind of how markets work, right? Typically, if you're shorting against the house doesn't like to reward you. They like to punish you for betting against them by bleeding your bank account to where you can't take the short anymore. And then once you're out, then they drop the price. And that's pretty normal. Yeah, somebody says when you attack someone's idea, they sink in and rationalize why they believe in theirs. Luigi is saying absolutely what people don't do. If you disagree with somebody, well, I don't know. See, my thought is this, right? It's big business to sell opinions on news, stock markets, whatever. Very few people teach trading mechanics. Most people even say they teach trading. We teach like charting. So the way a trader thinks and the way a news person thinks is completely different. People in the news realize that ratings is where you get your money. There's obviously a market share of polarized bulls and bears here. And if you're a very loud bear, you're going to get a lot of followers from that. And it's okay if, it's okay to be wrong, but it's not okay to like spin things incorrectly and use your big following to spin propaganda that is completely like not even educationally appropriate. Like you're making up stuff and teaching. Well, like I said, I don't care what they do. If the people want to go out there and hand me their money on the other side of the trade, I'm not gonna complain. But honestly, I just think it's strange that people are so quick to just latch on to someone that agrees with them rather than learn why they're wrong. If I'm upside down and losing in a trade, I'm gonna find someone who's winning and be like, hey, how did you see what I didn't see? I wouldn't be like, well, I'm still right. You're not. And that mentality is what all of you will fight as a trader. To know when you're wrong, get out of the way, figure out what's right and get on the right side is kind of like the art form that you get good at over the years. Everyone wants the next big short to be about them. Yeah. I think if you want my honest opinion, I think the market goes to 500 this year. I think it teeters around there. I think it pulls back above. It goes above 500 and then pulls back. SPY I'm talking about. But it doesn't go into any market crash. We just enter slowdown of growth. The market is, people have never traded through a bubble before when it's just forming. Will understand the power of stupidity. The universe gave you all a hint, all you new traders out there. The universe is blessing you in the year 2020 and 2021 by actually showing you what a bubble looks like. It may not have been related to what you dealt with, but do you remember hearing about crypto and NFTs? Do you remember crypto and NFTs for like 2 years? Remember for like 2 years, it just went up and you made fun of it for going up for 2 years. That's the same thing as the housing market with the adjustable rate mortgages. Like I think Michael Burry knew in 2004 that was gonna be a problem by 2007. And in 2005, he started shorting and he was 3 something years early to the party. He ultimately was right, made billions of dollars off of that. But if you guys remember, his collateral payments on those default swaps are $75 million a year to maintain that short, right? And he fought through corruption and everything else to finally make it. And the whole time he's sitting there like, everyone's wrong. It's going to crash. But see, the thing is that bull stupidity outweighs the single bear genius. And it doesn't matter why people want to buy NFTs or whatever, but they do. And you saw the stupidity of that, right? 2 years. I'm saying it's a stupid investment. I'm saying stupidity is bullish frenzy. There's no basis other than people not wanting to miss out. And the minute people stop firing money at something, then it stops appreciating. As long as there's somebody that wants to get in, there's somebody that wants to make profit by getting out. And then markets will go up and up and up until people are done buying. So your job now as a trader is to measure and observe when people are done buying. Do you know what I'm saying? Bull stupidity outweighs bear genius. That's very true. So it's like, you know what's funny? If I sit in a debate with a bear, every time they say something, I'm going to nod my head and say, I agree. But the yield curve is inverted. That's bearish. I agree. We're trading 25 times over earnings on companies A, B, C, D, E. That's bearish. Or they say that that's extravagant. So yeah, I agree. People are buying into this AI frenzy and there's no utility for AI. Yeah, I agree. We don't disagree on anything other than why markets move. And markets move on the same reason anything moves and changes price, supply and demand. It doesn't matter when you throw $1 million at an investment. The investment doesn't say, wait, are you bearish or bullish though? The investment doesn't say, hold on, before you buy me, the thing you're trying to buy just puts its hand up and goes, wait, don't buy me yet. I need to know, are you bearish or bullish? What is your thesis on how many times over earnings you're trading? Any investment will willingly accept your money and not care why you're doing it. So as long as you're willing to buy, you can be a fucking moron and still buy, and the investment will take your money. So the idea is not to say with a megaphone, people are morons and you shouldn't be doing this, everyone. Sky is falling. The real trader is going to sit on the sideline and watch stupid people pile on top of stupid people and stupider people pile on top of the stupid people and completely stupidest people piling on top of them, and just watch until the dog pile stops getting bigger, right? And then get out of there long. While the entire time there's people on the sideline betting against that, one of the two traders will make a whole lot of money. So your job as a trader is to recognize two things. Number one is, what is the trend? And two, make sure you're not the last person to that trend. That is the rule of trading. What is the trend? And don't be the last one to it. It's like why we exited DD bands sometimes. I try to be first at the trade with I long on a red candle off a hedge pressure, things like that. I try to be as first as I can, and I try to be out when other people want to get in. Like I could say, all of this economic data is very bearish. Very bullish. The curve fitting issues that arise for technical analysts and things like that will look at past history and start to say, okay, we're seeing the 10-year yields go up. Yeah, we've all read every trading book on the planet that shows that the 10-year yield goes up the 10-year yield goes down as people pile into the 10-year note as part of a money diversion from equities when they see a looming recession coming through. Okay. Why 10 years? Well, 10 years is the typical length. I may not teach you this, but 10 years is the typical length of any short-term debt cycle that comes from a short-term credit crisis, right? You have typical in the American economy, you have historic long-term debt cycles that last between 50 and 100 years a pop. 1929 was one of them. 2008 was the last one we had. These are longer-term credit cycles where you have wider, more broader market collapses in everything, right? That happens very sparingly. It's going to be once every 3 generations, we'll see a massive collapse. So we had one in 2008. There's not one coming until my grandkids have kids, okay? So that's out of the way. Now you have shorter term cycling in debt, which typically is 5 to 10 years a pop. And those cause pullbacks against rallies and things like that. Short-term credit cycle is typically what you should be thinking about now. Not market collapse, not we're going to fall to zero. Impossible. People going back to work and GDP on the rise. Demand is there for products and demand is there for labor at the current price of labor. Economy couldn't be any more healthy despite the problems we've seen the last couple of years. Things are looking great. They're looking great going forward. So now a short-term credit issue, yeah, like the short-term debt cycle could be cycling back around, right? We did go on a 13-year bull run in a period of QE, and now we're entering QT. Obviously, when the full effects of QT are realized, you will see slowdown in lending, which would be a slowdown in spending, which could reflect and slowing down of jobs growth and lowering of GDP growth rate and things like that, yeah, you can see that start to build slowly over time. Not it's going to happen tomorrow on the first 30-point pullback in the S&P. You know, in the last, I don't know, 60 or so trading days, the S&P hasn't had a 1% correction day, period. Your job as a trader is not to see that and go, this is just ridiculous. I don't understand this. Your job as a trader is actually like, let me just watch this and not be the last one to this run. The longer you doubt what is, just tell yourself this, right? Say, I'm a trader that's been trading for fill in the blank years. And I'm trying to say, I don't believe this market, it needs to turn around. And then your next sentence should be, wow, I've only been trading X years. How stupid am I to think I'm smarter than people that have been trading 40 years and 50 years and 30 years? Me with my 2 years of charting experience, how is it that I'm smart enough to time a stock market against the most powerful algorithms traders in the world? And then you should remind yourself that that's just a silly exercise and not try to do that. Every one of you in this stream is less experienced than the most amateur fund manager on the planet. I promise you that. They've got more experience, more money, more wisdom than the stock market, and more power, more algorithms than we all do together. For me to sit here and doubt what they're doing and say, I know better, I sound like a fool. So it's not your job to say, I don't agree with Wall Street. It's your job to say, I need to be humbled by what I see. And let me see if I can't figure out what can I learn from what they're doing? Well, let me time and watch and see what they're doing and just follow what they're doing and not doubt like I'm Matt Damon doing math on the chalkboard at MIT. Like literally, you're not the smart janitor of the stock market. Just try to. And when markets are bearish, you will know it. You're going to see the positional data, rocket scooter, monthly maps will show you. Liquidity maps will show you. You'll be breaking hedge pressure, monthly hedge pressure. You'll be getting all kinds of irrational signals. DD won't be 97%. 97% DD. Why is the market going up? Because 97% of stock market cap in the S&P is in a bull zone. Those are calls that were sold that are in the money, that are forcing those call sellers to accumulate those shares as those calls come to maturity and expire. So why is the market going up? Well, everyone's bullish. Well, then that's silly. They shouldn't be bullish. Well, yeah, you're right. I agree with you, bears. They shouldn't be bullish, but they are. If you really want to answer the question why, tell yourself this. Do you remember in 1998, this thing called the internet happened? Well, actually, it was actually in the 80s the internet happened. But in the 90s, the internet started becoming bigger. Once schools got on the internet, high schools were getting computers and a computer lab that could connect to the internet. We took an internet class in middle school, or a computer literacy class that taught internet. I was like, this is this thing. You can connect to the school library. You can download stuff. Wow, cool. Okay. But it seemed like something that would be stuck in academia. It didn't really seem like something everyone would use. And of course, everyone at home. Imagine the scenario, right? You sit at home, you run out of toilet paper. You hear about this thing, you have the internet, and you're like, I need some toilet paper. And God, Walmart's like a 10-minute drive. Ugh, I gotta get in my car. You're like, okay, you know what? Let me go to the computer. Okay. You're like, hey, everybody, get off the phone. I need to go on the computer. I need to buy some toilet paper. Plug in the modem, click the button, beep, 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 boop. You got all those, internet sounds playing. You dial on the internet, and it's like, you've got mail. And then you go in there, you're like, okay, wait, what is it? www type dot something dot. Okay, cool. I'm at some website. All right, I can order some toilet paper. All right. Wait, I got to type in my credit card and my address and all this stuff. God, that's delivery time 2 weeks. Wait. Okay, you know what? I've been sitting here for 20 minutes already. Fuck this, I'm going to Walmart. Like, nobody used the internet for anything. And that's the reason that the tech bubble popped. And it's 2 rules of thumb here. And this is how you know something has utility. if your grandmother is using it on a daily basis, it's got utility. So like, you know, crypto, my grandma recently passed, my grandma would be able to go to Kroger and buy a loaf of bread. With Ethereum, that shit's got no utility. The other thing is if you can't use it for running your government, or like for instance with Bitcoin or crypto, if the government doesn't accept that as a form of paying your taxes, it's never going to be widely accepted globally. So at the end of the day, the internet had utility because not everybody had it. It was hard to get in. You had to do all these steps. And then, you know, commerce didn't exist on the internet any length of time that made sense. So it wasn't something everyone used. And like you fast forward like 15 years, you want to get toilet paper. You're like, I got to drive to Walmart. That's like 10 minutes away. You literally I can go to Amazon right now, buy toilet paper within 10 seconds, and it would be delivered to me within an hour. See, that's the internet people bet on. The 90s, just high-speed internet and constant connectivity that allow that utility to be there. Now, the thing is does AI have the utility now, or does it have utility later? And that's a very good debate to have. And let's saying that's not a terrible debate. Some may argue, yes, AI has utility now. Others may argue AI has no utility now. It's just literally like Alexa. It's just a chatbot that talks to you. And the answer is both of those are true. You know, you don't have robots driving your cars yet, but is your grandma using AI? Absolutely. She doesn't even know it. Like almost all apps now are utilizing some early adopting form of this, what the people call AI. It's not even really AI, but in all honesty, every app is doing that. I mean, Snapchat is using some form of AI to do facial recognition. I mean, that is the future, right? The question is, how early up to the bet are we? And you have to think that in the 90s, people that said the internet's going to be the next big thing, and the bears back then were saying, no, there's no utility because there's dial-up. Nobody wants to use it yet. And the bulls ultimately were right, but the bears were right at that moment in time. And so the bubble still formed. And the bears were right that the crash is coming, but the bubble formed because people knew it was the future, and they longed and longed and longed and drove up the price. And maybe they held for 15 years, maybe they got squeezed out, but at the end of the day, they were right. Because if you would have bought Amazon when it was worth 50 cents a share, you'd be happy today with that choice. Now, people that missed out on it in the 90s, people that were bearish to the internet after the market crashed, they were like, see, this tech thing doesn't work. And people scooped it up in 2003, 2004. They were like, you know what? This is the future. It'll be here soon enough. In 2004, 5, and 6, MySpace was big. Then Facebook got big. And you knew at that time, if you saw social media being the next big thing, that's the real billion-dollar trade. If you long the stock market at the bottom 2003, 2004 era, because you saw social media being the future, you caught the last bubble, which is why oil companies were replaced as the top 10 stocks, the S&P, with tech companies because of social media. Now there are people who missed out on both of those trades, the internet boom and the social media boom. Now they've got a fund manager who was laughed out of his office 2 different periods in the last 20 years in his 20s. He was the bear that said those things aren't worth it, and then they didn't work. But then they worked, and everyone made money but him. And now he's 40. Now he's sitting here. In the recent memory, he missed out on the last 2, he or she missed out on the last 2 big rallies on tech. And now there's something called AI. And now you can actually see it. AI makes Instagram videos for me that I don't have to do anything for. AI is writing movie scripts, and you got people out there protesting the fact that they're losing their jobs to robots, even writing, right? Certain things. There are companies that message me all day long. They're like, hey, let me rewrite your website. Oh, I did it for you. Check it out. And literally AI rewrote my website. And they're trying to pitch it to me like it's their own service. You can tell that. So the utility is somewhat even there, and it's just the birth of it. And these fund managers out there remember, this is the thing, they remember missing out on the last big fads. They even missed out on crypto maybe because they thought it didn't have utility. So whether it has utility or not, the real mechanism for this rally is that people don't want to miss out on the next big thing. they remember missing out on it the first time, the second time, the third time. And AI is such a marketable thing right now, and it's actually very widespread and has small to moderate utility already. Who knows where it'll be in the era of quantum computing in the next decade. So the idea is that in no way, shape, or form does anybody seem to want to be missing out on the next big thing. And you just have to see it like that. And you can sit there and say, well, I disagree. It has no utility, it has no this. You can join podcasts and spaces and argue against it all day long. It doesn't matter because supply and demand fuels the market. As long as people are throwing money at it, it will go up in value. Your job as a trader is to keep an eye on what you think should happen. But in reality, your job as a trader is to monitor when people stop throwing money at it. You're trading and betting on what other traders will do. You're not betting on the correctness of your thesis as a trader. Remember, this is what you want to write down. As a trader, you're betting on what other people will do. And if you're the smartest in the room with the best thesis, that's great. Assume everyone else is morons, and your job is to watch those sheep throw money at it, and you need to bet on when they stop doing it. The dumber they are, the easier it should be for you to see that. You're just supposed to monitor what people are doing and bet on what they do. You're not betting on, when you bet on market going up, you know what you're really stating to the universe? I'm betting that I'm going to buy and that other people are going to buy after me because I was smarter and got in first. That's really what you're saying. So if you long a market, you're betting that other people are going to long after you, right? So if you're shorting a market, you're betting that other people are going to come sell after you shorted. In reality, every bet you make is you're actually betting on people and what they're doing. Don't bet that people are smart. Bet that people are just dumb and make dumb decisions. And your job is to see what they do in mass and monitor and watch. Not testify to the world that they're wrong. Clearly, they're wrong. The more wrong they are, the easier your trade should be. The easier for you to see their stupidity and how it's fueled. That's why I always say never underestimate bull stupidity. Bull stupidity will always outpace bearish genius. That's a good rule of thumb. I think that dopamine hit from being short is bigger than being long. Traders have it, yeah. Elon saying NVIDIA do not supply chips they want. Bears still to this day. Short NVIDIA. Bro spinning facts is their way to go to previous monthly maps. We want to create a way to animate monthly maps historically. That's just something we can't currently do yet. We're going to have to build it. So essentially, you grab a slider, you drag it left to right, and it would animate the monthly maps as they change historically as you're moving. Shiv said, Matt, you're 100% right. Some influencers are paid to generate fear in the public. They come out collectively with bear thesis. You and a handful of influencers are being honest about the current market, except, oh yeah, they're all trying to sell books. And Andrew says Beanie Babies. Yeah, dumb stuff, right? It took me 2 years to filter out the fake influencers. Now you just follow like 10 to 15 folks on Twitter. They have been 100% spot on the trend. Sorry, anything. Well, I appreciate that. Honestly, I don't even like to say that like I'm, like that. I don't feel like I'm doing anything extraordinary, to be honest. What I feel like I'm doing is very basic, very simple. I'm not trained as an economist. I'm an engineer. The engineer is all about seeking data and seeking facts and things like that. They're very important. And honestly, it's just when you understand that you can see where people are positioned. If my job is to monitor what people are going to do and bet on what they're going to do, I don't need to understand why. I just need to, if I'm bearish, then I would have a thesis that's bearish, but bearish is not going to explain why markets are going up. Markets are going up because people are longing markets, outpacing people selling markets. And so my job is, if I can see where people are positioned and how those positions change over time, that's really all I need to know as a trader to time my investments. If people are buying, why am I going to bet that I can tell when they're going to stop buying? How many people are left that haven't longed yet that want to long? I don't know. How much money do they have to long with? I don't know. How about the people that long before? Do they want to go longer? How much money do they have to long? I don't know any of that detail, but that's the metrics you would need to exhaust. Like, imagine I can see the total number of people who want to be bullish and how much money they have to long. I'd have exactly the amount of money that could flex into the market and push it higher. And I know when they run out of money, and then I'd short. But see, I wouldn't know. You don't know the capacity of people to have money and spend it, borrow money and spend it, sell assets to raise money and spend it. You don't know the extent at which people have to funnel money into the stock market. Yojimbo says, engineer is about problem solving. You're engineer as well. That's right, baby. You know, the engineers just look at data and make very... It's funny when people talk to engineers, right? We're not sitting there doing calculus in our head. We're just like logic thinkers. We see data, we compile it very quickly, and we make pretty generalized decisions. They're estimates, they're good enough, but you know it's the right answer, right? Engineering was never an exact science. It was like artistic science. And in reality, it's just all about looking at data and just seeing the logical side of things. And they train you to think like that in school, and that's kind of why Yojimbo gets it. You don't disagree with what I'm saying, but you're espousing the bigger fool theory. Eventually, reality will smack stupidity in the face. Yeah, but the thing is that it's like this, right? I don't go to a party at 6 o'clock and not drink a beer because I know I have to drive home at 2. You know what I'm saying? If you think of it like that, you know the party's got to end. But why go to the party if you're going to sit there in the corner and watch everyone else drink and just say, you know, this party is going to end, everybody. Why are you drinking? You know what I'm saying? Like, why even trade? The point is why even trade to begin with? Like, the goal of trading is not to bet that reality smacks things into the face. Unless you've got billions of dollars and the ability to pay the collateral on some kind of swaps or shorts, or pay premium on options to survive until that party ends. That's how bears make money. They throw mass amounts of money at it. They hemorrhage until they're right, and ultimately they win big. Because the less probable thing always pays out the most, the trader that's in first. And crashing markets is the less probable thing. Markets spend 99% of their existence not crashing. So yes, eventually reality smacks something in the face. But in all honesty, the markets traditionally just always go up in general. So your job is to just time when they're going up and when they're not going up. And then, yeah, reality always smacks the market in the face at some point. But the idea is anybody could time that perfectly, and somebody would infinitely be wealthy with no extent to their ability to predict markets. And none of us can do it because you don't know how much money people have to spend and when they're squeezed. This is just all stuff that it's hard to guess. And so the goal is that, okay, let's build a trading style that doesn't have to guess that. Trying to bet on reversals is just a hard thing to do. Now, if you guys see my Twitter feed, I've gotten all the big reversal points right, but I have to spend months building a thesis. Okay, this is finally it. Y'all saw my post on that, right? It's all about timing, as Ralph said. You're right, 100% agree. The idea is that being early on a trade is being wrong in a trade. Doesn't matter if you're right. A broken clock is correct 2 times a day anyways. So you can always go in and be right or wrong about the direction. And if you wait long enough, you'll eventually be right on the direction. But it costs money every moment you're wrong. So trading is, like you said, about timing. That is the mechanism. So the paragraph you said, you know, the bigger fool theory, eventually reality smacks you in the face. So it's an issue of timing. If you could delete everything you said in that paragraph and just said trading is an issue of timing, then you're correct. Trading is an issue of not trying to time when people change their minds. Reality always smacks bears in the face, always smacks bulls in the face. But then that's not what trading is about. Trading is about identifying what people are doing with their money and betting on what they're going to do with their money before other people can do it. If I was betting on reality slapping the market in the face, like you said, I don't just, like I said, every bear thesis I always agree with. I definitely agree. Then people that are long, let's imagine that somebody that's long, everybody's long the market right now. Let's imagine one person has inside information, just one person who runs a large bank. and that one person has inside information, they're even cheating, right? Insider. Joe Biden, Jay Powell's golf buddy, who knows, gets inside information, gets a tip, right? Something bad's about to happen. I'm going to pull the plug on you. Market's going to dip and whatever. You're going to start to see that person who's long selling massive amounts to get out first and take profit. You will start to see even evidence of one or two insiders starting to sell the market. You're going to see, as you said, reality slapping in the face. You're going to see the giant hand slapping someone in the face. You're going to see somebody behaving that way. You need the hand to slap him in the face. And so where's the hand? And that's all we want to do. We're going to watch and watch and watch. And one of these days, you're going to see some red candles. We're going to come here a week later. We're going to see that dipping and maybe that shorting. Illiquid market and a bunch of red candles. Okay, guys, that's it. Here we go. Right here. People have been selling, and yet markets still go up on a short squeeze. But just about right here, right, you had a period of, right here, selling and shorting at the same time. You had markets fall for like 2 or 3 weeks, and then you go, oh, illiquid market. Shit, the party's over. Well, oh, we're trading below monthly hedge pressure again. Yeah, definitely party's over. We're probably in a recession now. All right, well, that's probably it. Okay. Oh, the market's green. Cool. Yeah, let's look at this. Oh, yeah, it still looks kind of iffy. Everyone's selling. Market makers are covering. Yeah, that's definitely bearish. Okay, you know what, guys? I know I was a bull for the last 3 years, but you know what? I'm going to be a bear. Shit, I was like 3 weeks late to the party. Oh my God, I'm not going to make any money being a bear. But all these people not only didn't make money being a bull, they lost all their money trying to be a bear. It's better to miss out on 2 or 3 weeks and not be the first on the other side of the party, but basically you will get your signs. So the market will sell. Longs will go less long. The basics of why markets move. You will see this. You will see data. And then bear markets last for years sometimes. So if this is going to crash, you're not going to miss out on it. You're just going to miss out on the start of it. Fine. But you will see it. Yeah. Rather be rich than right. The thing is that when you are rich as a trader, you're never right. Your opinions that are right, people don't want to hear them. Typically, the more successful you are as a trader, the more wrong you are in the face of everybody. Because you're first. And the funny thing about being first is like never regarded. You're never regarded as a hero. Life is like this in trading. If you're wrong, everyone will make fun of you for being wrong. If you're right and you're first, everybody will make fun of you because you disagree with them. You saw something they didn't. Nobody, they're going to laugh you out of spaces and podcasts. Been there before when you were dead right. You make a lot of money on your trade. No one's going to be happy for you because they all lost money. They're going to be salty. There's never a time in history when a trader gets loaded on his shoulders like Rudy, the football player, and marched out of the stadium, celebrated by all. You are hated the entirety of your trading career, especially when you're right. You have so many people hate when you're wrong. So now let's just be honest. Like, I was a bull. Market's going to double the next 3 or 4 years. I said in the 2021 right here. Even in this time, people are calling for market crash and recession. And I said, there is no recession. We just left one. Why? The period when GDP growth was negative. That was a mini recession. We just left one. S&P is going to 6,000. I said it in 2021. I'm using positional data and other techniques that I do. Right here is the only time I said, actually, futures suggest more downside. We're trading below like monthly hedge pressure and other things. This is the first time in as long as I can remember that I'm seeing a possible short-term correction. Literally, the first red candle that came up, I got all the data that looked bad, and I called a short-term correction. Volatility is going to take over this month and likely for the quarter. Sidelines would be a good idea starting now. Imagine this. Imagine letting it fall and come. Actually, it was this red candle that made me say that. None of these other ones made me say that. Here's the correction. Right here, here's a 2-month bear market rally right there. We exactly 2-month bear market rally. Here's the bottom until summer, okay? Summer for lower lows. We approach the spring. Breaking news, monthly map shows that the bull sentiment is no longer summer. It's reflecting from late July to October now. So now it's even bullish till October. Here, economic data implied that there was no recession coming. So being able to, it's two different things, right? The economic data that was good that said recession is over is literally coming 9 months after the market bottomed. See, it's not that I guessed that the recession was over here. People are betting that the economic data is improving and then it realizes its improvement here. People always bet on something happening in the future first. And if people are longing the market and you see the evidence that they were correct, economic data is great, GDP growth, jobs data is down, everything was looking great for recession to not be possible anymore at this point, then the bulls were betting on that this much earlier than it happened. Maybe market makers following your Twitter, maybe. But you see how, like I try to tell you guys, don't try to time things. You see how like it's really hard to time a top. I think like I got a lot of data piled on top of itself, but it's much easier to time a bottom than it is timing a top. They always say tops are processes, bottoms are an event, right? That could be further than the truth. But I've been doing this for for 14 years. It's not easy to even do this, right? But I am just looking at data. I'm not out there. I'm not digging through earnings calls. I barely pay attention to earnings season other than the print. Like that's it. The forward guidance, all I really listen to what they print that day. I don't think too much into it. I watch what people are doing and I watch for them to stop and watch for them to start. Here's what a crash is going to look like. You're going to wake up one day. Market's going to break hedge pressure. It's going to collapse and hit monthly hedge pressure and then collapse. And they're going to wake up the next day. You're going to be below monthly hedge pressure again. And again and again. And remember this year, there was like 2 or 3 days, right, where we broke through monthly hedge pressure. And then the next day, we broke through it again. You guys remember leading up to expiration? And then we came up on Monday after, and we're trading well above the new month. You're so safely buried in bull territory right now. Market crash isn't even mechanically possible. Unless somebody just starts brute force selling everything they have. And why they would do that unless they had inside information on something big. And I don't know what that big thing would be. But every day I watch. If I break through hedge pressure, I'm out of my longs. And then if it crashes, then I missed out on the crash. Who cares? I just didn't hold my long while I crashed. And then I wake up the next day, new liquidity map, wake up the next day. And eventually, the liquidity maps will start waking up in bear territory. And then it's, oh, okay, now I'm in bear trades. Okay. And then it just basically becomes that. Like all these different indications we have are showing me where support is. There's support there. BLU, there's support there. Okay. Then if people decide they're done with the bull market and they're ready to sell, then they will sell and overpower that long hedging. Okay, boom. Now I can wake up and say, oh, okay, maybe the bull market's over here. Every day I'm staring at the party, and maybe the party's over. I hear a siren down the street. Oh shit, it's the cops. But I'm not saying, oh, the music's loud. I'm not peeking out the window every 2 seconds to see like, are the cops coming? They're gonna break up the party or what? Res is hanging around 0. Outside of DD band, it's irrational. You want it to be greater than 10 or less than -10. Mm-hmm. You know the party analogy? Am I revealing too much that I like to party a lot? Well, I work really hard. I deserve to party a lot. All right. I'm gonna have to test some trades over here on my end. Let me make sure I'm. Hold on. The easiest thing you can do as a trader, if you stuck through this stream the longest, is to learn to pair the commitment of traders with the Rocket Scooter monthly map. Those two are forecasting tools to forecast the end of the party, or at least see it when it's over. If you want to see the future with the extent of which people are willing to spend money on the future, you click this monthly map and you will see what people want to do in the future. These are existing positions and options through the future. This dark gray is, this dark gray are calls. These are calls sold by call market makers, call dealers to other dealers of the underlying SPY. As you see at this current price, as time goes by, let's make a chart. As you go further out in time from here, from now, you have more and more and more and more calls in the money. At this price, look, the calls that are in the money is just this big. Move here in time, calls that are in the money is this big. More calls are in the money. Move further in time, more calls are in the money. If the price stayed exactly the same for the next 3 or 4 months, you have more calls are in the money and more calls are in the money. So imagine that you're the options seller and you sold 360 calls, but for this expiration. They're way out of the money. It doesn't matter. I mean, sorry. They're way in the money. I guess, let me do a different example. An easier one to understand. If price stays the same, then every call that's in the money may or may not have those shares in case they're exercised on. So the bigger this area is under this curve, the more strikes are in the money at that expiration. If you sold a call and you don't have the 100 shares for it, you need to go get the 100 shares at some point. So if there's more and more and more people in the money, the people that need to go get the shares at some point, there's just more of them. So there's a higher probability as the dark gray line slopes down that there's more people that have to long against their will because they have sold calls that are in the money. They must long between now and here. Now, I don't know when they're going to long between now and here to acquire those shares. But you know, as long as these positions are there and they update every day, that somebody has calls in the money. And as you get closer to expiration, at some point in here, they're going to need to go out there and also buy 100 shares. And there's more people that need to do that. There's more people that are not only want to be bullish the market, but people that sold calls that have to go long the market to supply the shares to those who want to be bullish who bought the option from them. Monthly map how it changed, and Garrett remembers. Do you remember? Garrett remembers that it pivoted like this, and we showed September being a pivot, and all of a sudden, monthly maps are showing no pivot. Period. There's no pivot anymore. That's what he's talking about. There is no pivot to the bull side. The bulls are not going to stop buying between now and October. Let's look at the call side or the put side of things now. Here's the puts, right? You see the bear side is obviously people bear side is overall over time deteriorating until about here. So between here and here, it's the same thing in reverse. At this price, nobody is out there shorting the market or selling the market to exercise all these puts that are out of the money. The majority of these market maker puts are out of the money. So there is no selling pressure on the sell side of the options market because puts are out of the money and becoming further out of the money, which means the probability of people selling to exercise those in the money puts gets even smaller. It's a smaller box. So The bull box is getting bigger of people that have to long. The bear box is getting smaller, people that have to short. So the picture that's being painted is forced bulls, bears fleeing. Bears getting out of their short, bulls getting in longer. When both of those things happen, that's a twofold rally. Longs getting longer, and then shorts covering. Okay. Up until here, and then here you start to see the market inflect. The bear side slightly. Well, actually, no. Actually, I drew that wrong. The inflection is only here. And then it... Yeah, that's right. That's right. That's right. So, as you see through this period, there's a wave of shorting that's going through again. So between here and here, one can see between now and August 18th is that there is a double squeeze or a double power rally on a short squeeze and long up until about monthly expiration. And then while the bulls are pressing really hard, the bears are also pressing really hard. So let's forecast the commitment traders off of this. Okay, ready? And I'm just going to draw it on the chart. Commitment traders, we'll talk to it in a second. That green line is going to become more and more and more and more green over time. No pullbacks. Nobody wants to sell. That's what's telling me. The blue line is becoming, the short is squeezing, 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 squeezing. Right here, the short is starting to build short again, like so. As we know, this is an illiquid pocket or illiquid period where everything's pointing up. This is a liquid period where everybody is, when it's fanning out, markets are liquid. And we know liquid markets also don't crash. Where the bulls and bears are selling and longing against each other, liquid markets don't crash. Right? So when I pull the commitment traders up, I'm going to forecast the future now based on what I drew. I love doing this. This is how I observe markets. So this blue line is going to get squeezed like I'm drawing until the end of August. Well, actually, let's just, I guess the end of August would be right there. And then it's going to start shorting again October. This green line is going to continue to go up and up and up and up and up and up. Pretty cool, right? So now I'm trying to use Rocket Scooter to solve the one problem that we all have as traders. I'm trying to bet on what people are going to do with their money. So I'm going to use monthly map to forecast what people are going to do with their money because they've showed me their hand. This is their options in the future. So that's the only evidence I have of seeing what people are going to do with their money, and I'm going to take a guess. And I've been doing this for a couple of years. My accuracy on timing those pivots, I'm going to tell you, when Ash and I teamed up, and I showed him some of my tweets, he's like, how are you getting that accurate? It's this. This is my secret. This is my style. When I tell people it's hard to time tops or bottoms, it is if you're just purely guessing. But people are going to tell you when their appetite changes for something. We see the monthly map starting to manifest slightly differently. And this, if you pair it with this, you can forecast. The long's going to keep longing, keep longing, keep longing. Bears are going to get squeezed to the end of August and then continue to short. But even when they're fanning out, it's liquid enough. So the stock market is literally going to accelerate and probably hold at 5,000 by October and sit there. It's not going to crash because liquid markets don't crash, and it's not going to rally. It's not going to sell off probably until the long starts selling, which there is no evidence of that yet. Not in S&P. So I use when I showed this to Ashton, this is where he's like, dude, we need to join forces. He's like, imagine knowing when you switch from selling credit spreads to selling put credit spreads because you have those pivots there. With the options, you don't have to be entirely accurate. You just have to be kind of within the vicinity of what's not going to happen. And so clearly what I've been able to do here, and again, this is not investment advice, it's just my opinion, some schmuck on the internet, don't listen to me. But what I'm showing you right now with this analysis, all I need to know is what's not going to happen. And what's not going to happen is the market's not going to crash. It's going to rally really fast, and then it's going to be too liquid to crash between now and October. So when I revealed this monthly map thing, I was like, Ashton, this thing called monthly maps are building this, and he was like, dude, you know, you build something that tells you what's not going to happen, right? He's like, imagine the potential of selling options, because selling options is you're taking the bet of what's not going to happen. I'm selling a call. Market's not going to go up when I sell a call. If I sell a put, market's not going to go down. That's my bet, right? So ideally, seeing positions, it makes all the sense in the world. Most of my analysis are these two things side by side. And I'm trying to forecast what institutional positions are based on the institutional options and how they change. Because these options exist until a point in time, and every day I wake up and reanalyze this. So I'm predicting the commitment of traders. I'm predicting where markets will flow based on where it's telling me they'll flow. Now, I could be wrong. I could wake up tomorrow and this can change. And the best beautiful part is I wake up tomorrow and this changes, then I change as well. I just adapt every day. When's the party over? Well, whenever the calls start doing that. So I don't see any sign that the cops are coming to bust the party up yet. And this to me, oops, let's save that. These are fun. And this is how I like to read the market. And hopefully, as time goes by, this will start to gather like a lot more steam. Bull side, bulls non-stop. Literally. Bear side. Bear covering. And then here you have an inflection point, which is part 2. Let me draw a little better. So to me, why I built Rocket Scooter is I wanted to build a tool that could let me see a monthly map. I wanted to build a tool that can let me see people's positions in the future. And when you think about that single sentence I said, it's like, isn't that what we've always wanted to know? What humans want to do in the future? In every attempt I do at making something new, the goal is to try to reveal what someone wants to do in the future. Because in all honesty, your job being a trader, the more first you are, the better off you are at something. 2 hour stream. Oh yeah, we're having fun today. We're doing it. Okay. So let me just let me draw this with. I want to make a little tweet here. I got blocked by the bear propagandist who said the credit event was starting today. Credit event. Okay. Ready? I'm gonna predict. Actually, let's do this a little better. So every day I'm just gonna wake up and I'm going to monitor this monthly map. And again, when it changes, I'm going to change. I'm not trying to guess or predict. Based on like opinion or fundamentals. I'm just reading people's positions and then that's it. Actually right here. This is the inflection point. Let me draw the right one. So I'm just reading the market. Okay. Hold on one second. Hey guys, I got a meeting. I got to head out of here. I totally forgot about it, but we'll be in Zoom in 2 hours. Love you guys. I got to get out of here. Oops. All right, bye.